How's everybody holding up? Good, I hope. Good, I hope. All right. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure: I got out of the TQQQ short. I got out of the TNA long. That was it. That might have actually been a day trade. Got out of Chewy long, and well, I got out of the IWM puts, which glad I took those. Helped me out a little bit. Bought some insurance at 2 o'clock yesterday because I did not like the sound of what the Fed was saying with the reduction of that dot plot for the IWM. And that's my biggest frustration. So let's talk about the market. SPYs are up 0.2%. The Qs are up 0.6%. The IWM is down 1%. Say that again. The Qs are up 0.6%. The IWM is down 1%. TLT is up 1.4%, which that's a little bit of a conundrum. I'll circle back to my thought process on this TLT again in a second. But yeah, TLT up 1.4%. Interest rates are down. Should, in theory, be beneficial for XBI, which is down 0.25%. IWM, which is smoked. ARC, which is smoked. But it wasn't, which we successfully kind of called for that in the morning meeting today, just based on this evolving story. These last 2 weeks, I have really found to be particularly tricky from just a general thought process perspective and from a trading perspective. I've actually felt like these last couple of weeks have been some of the more difficult trading that I have kind of experienced in the last couple of years, believe it or not. And really, it's just because it's been tricky to kind of analyze this evolving story, right? It goes back to, I guess, 2 weeks ago when we started to see some consistent economic numbers that were missing, but then changed a little bit last Friday when we had that strong jobs report. And then yesterday we had it's an interesting situation yesterday through this morning with the CPI miss, the really big PPI miss, and the Fed decidedly more hawkish in their approach. And I said it in the morning meeting, I'll say it again today. I really try to give the Fed a lot of credit. I want to give the Fed more credit than probably most like CNBC pundits would ever give the Fed. Sure, they were late into the hiking cycle to begin with. We all recognize that. But ever since they actually started the hiking cycle, I thought that they've overall done a very, very good job, kind of up until now. I really, really think that the Fed needs to start cutting. And I guess I've been probably complaining about it for the last day and a half at this point. The Fed's actions yesterday, I think, are really further creating this have and have not situation that I've spent a lot of time talking about. And actually is a little bit the opposite of what my expectation was coming into these last couple of trading sessions. So, again, I guess just to kind of recap the macro a little bit out loud, because it can help me wrap my head around it a little bit as well further. We had just this great CPI number if you want to get inflation down yesterday. We got a great PPI number this morning if you want to get inflation down, if that's the goal. And that was after a pretty good jobs number on Friday. So in some ways, to me, it really seems like the most Goldilocks situations when you just kind of combine these numbers that started last Friday. Economy's humming along, people are working, the labor market's tightened up a little bit, but it's still, exceeding expectations and holding in really well, and I don't think it's indicating any sort of upcoming recession at all. I think that the consumer overall is still doing really well, and that they're gonna continue to spend. At the same time, a miss on CPI. That headline year-over-year number, I'm not exactly sure where it is. I think it's 2.6%. I know it's under 3%. So we've got a 2 handle on there. So, you know, in kind of the home stretch, it seems like. And then you get hit with this PPI number this morning, which, like we always say, that the PPI doesn't move the market as a CPI, but it's definitely still notable when it's that much of a miss. But the thing that we were able to recognize in the morning meeting today, which I think was a really good job because it flies in the face a bit of how the market has been trading, is that big miss on the PPI actually should have created a big boost higher in the market, and it especially should have done it for the more interest rate sensitive parts of the market. But we were very on top of saying that probably won't happen. Why? Because of what the Fed just did yesterday. The Fed just yesterday, despite this weaker CPI and PPI, I think overly brought down the dot plot and the maintaining of higher for longer of interest rates. Easily could have been conservative, cut it down from 3 cuts to 2 cuts, and just left it at that point and said data dependent, yada yada, like their language always says. But actually went with the lower probability move. I think it was the lower probability move of cutting it from the 3 cuts all the way down to 1 cut, and then increasing for 2025 by an additional cut. But so basically what that indicates is higher for longer. But in such an evolving picture, it's very hard to look at 2025, in my opinion. You know, a year plus out potentially through 2025, and say to yourself, I can be really confident about what the economy. Wow, is GameStop ripping on that? Yeah, GameStop catching a big bid on that. Wow. I'm not gonna trade. I'm tempted to buy some verse 30, but I'm not gonna trade this. I don't think. Slightly lost my train of thought. So we're basically just talking about what the Fed has done, where they're at as far as the cuts go. 2025 is kind of so far out when you're thinking about how many cuts are we going to get throughout the entirety of the calendar year of 2025, that trying to rest your hat on, well, they're going to give us an extra cut in 2025 is very difficult to do. I think the market's a little more short-term focused than that, and now the market is saying, hey, we're only getting 1 cut, and it's probably actually not even going to be until basically the very end of the year at this point. I think that's just kind of unnecessary, and I know we spent a lot of time talking about it. This just continues to increase the have and have not situation that we spent so much time talking about. Who doesn't care about interest rates? Apple doesn't care about interest rates. As a matter of fact, Apple probably benefits from higher interest rates. Who doesn't care about interest rates? Microsoft. Microsoft actually probably benefits from higher interest rates. These mega cap tech companies that have been able to raise debt at such cheap levels that are longer dated debt, and don't need to raise any money because they have all the cash in the world. They've got debt at 2-3%, and they're able to just get 5% plus on their cash. It's actually a good thing for them. I really think it's inflationary in some regards when you're thinking about these big companies, and it's just going to make them even bigger. And you can look at that from the case of companies. You can look at that from the case of people as well. If you are, and again, I'm happy to use myself as an example. I'm locked in on a mortgage for my house at 3%. I make money, right? I make money. I do well. The money that I make, I can just put that into a checking account. I think my public.com brokerage account, which has a bunch of cash in it, has a thing where I'm just getting like 5.2, 5.3% on the cash that's sitting there. That great for me. That's awesome for me. So I'm able to take all that money that I'm making off that cash and go spend with it. That's inflationary. That's not deflationary. It's literally the opposite. The only people that are getting hurt are people who are in their 20s who didn't have the opportunity to be able to go buy a house in COVID or already had a house and then they were able to refinance and lower their mortgage rate to 3%, the young people are getting hurt. And it's the same thing with these companies. Apple and Microsoft are great, but if you're a small cap, if you're a small cap or medium cap biotech stock or growth stock or whatever, you're getting absolutely destroyed. I don't think that a company like Uber, which is now a profitable company, and it took them years to get to that point, and they're doing really well. I don't even think Uber would exist if you were if you were trying to start Uber as a brand new company, as a brand new concept right now. I don't even think that this company would be able to exist. They were only able to get to the point to get through all of those years of losing money, of adding scale, of building a business because interest rates were super low. I'm not saying interest rates should go back to zero. That's definitely not what I'm saying. But I'm starting to get concerned that we're a little bit behind the 8 ball again with this Fed here, as we were when we started the hiking cycle with the cutting cycle. We're already starting to see it happen internationally, and I don't see any reason why we shouldn't be doing it here as well, especially because I really don't think that the Fed's actions have done very much at all to bring inflation down. This isn't the 1970s. This was a totally different situation that created inflation to begin with, and a lot of it came from supply chain. A lot of it has come from deglobalization, and the reason why it's improved in large part is because those supply chains have improved. And we've discussed in the past, I won't go into this concept again in today's afternoon meeting, about how globalization and free trade and no tariffs really would be a very simple way to be able to hit that final leg of getting inflation down to 2%. And I understand that there are other arguments that are outside of the realm of economics and finance on why potentially tariffs should exist. But if we just want to talk strictly about the economy and the inflation rate, and you're trying to get this last leg down of this 0.6 or 0.8% or whatever it is that we still need to get back down to 2%, don't increase tariffs, reduce tariffs, and you'll be there. I'm really confident about it. I think even with this last CPI that came in light, one area that I think the Fed mentioned that they were even surprised about was the increase in import prices. I'm not surprised about the increase in import prices if you paid attention to what our policy looks like when it comes to tariffs and what that's doing in that space. So I don't know. It's a little bit frustrating to me because I really had positioned myself for, I guess it's probably where my frustration is primarily coming from, positioned myself for and should be successful because of the big CPI and PPI misses. But instead what actually happens, and we were super on point with this in the morning meeting today, is when you get that big of a miss on the PPI, and you say, and the Fed is coming out and saying, hey, we're staying higher for longer, we're not cutting rates, all of a sudden the miss in the PPI isn't viewed as a benefit to the market anymore because interest rates are going to come down. It's actually probably a negative for the market because it's indicating that the economy is slowing down, but it's not giving you the juice of the Fed also cutting at the same time. So you took what could potentially have really been, I think, like a Goldilocks scenario for the market. And when I say the market, I'm not talking about the Qs, which is just Nvidia's and Apple and SMCI's, maybe not SMCI, but they're in the S&P. Not just the rip higher from these like 3 or 4 companies that have been propping up the Qs. I'm talking about the market. I'm talking about the RSP. The RSP, which has not performed at all over the course of the second half of May or June, despite the fact that the SPYs have ripped up to new all-time highs and the Qs have ripped up to all-time highs. I'm talking about the equal-weighted S&P. I'm talking about the fact that even on a day like today, when the SPYs finished up 0.2% and the Qs finished up 0.6%, that we saw a statistic at some point during the day today that 75% of the stocks on the New York Stock Exchange were actually negative on the day. So I'm talking about the RSP, I'm talking about the IWM. That's what I was trying to position myself for based on the CPI kind of numbers, and we got that briefly yesterday. It was perfect. Huge move higher off that CPI, and then the Fed came out and just killed it. They totally killed it. And again, that's what I was saying in the morning meeting today with the PPI is, hey, let's not get excited about this PPI leading to a big move higher for interest rate sensitive stocks, because the Fed just said that they're not cutting rates, and this actually, if anything, is indicating that the economy is slowing down a little bit further. Not so much where I'd be concerned about a recession or anything like that, but the economy is slowing down further. So once again, it just kind of leaves us with a tricky mixed message on this market. The IWM continues to look terrible. It's still broadly within its range. 202 is an important level. We closed just below 202 today. 200 is the really important level, where if you lose 200, I think that the Russell actually starts to look outright bearish. But we're still completely stuck in this range for the IWM. We're still completely stuck in this range for the RSP. You still have this big dispersion trade where, sure, great, Apple is going up, 7% in a day, Nvidia is up 3.5% in a day, but the SPYs are only up 0.2% on the day. So what does that mean? It means that all of these other companies are basically going to be negative in order for the S&P to only be up 2%. And the entire reason behind it is the Fed's actions yesterday. The Fed has the potential to create, I think, a bit more of a catch-up trade here that benefits younger companies that need to be able to raise capital, that benefits younger people who need to be able to participate in the economy and take on debt and buy homes and take on business loans and things like that. You're absolutely hurting those people while you're enabling, Apple with its bajillions of dollars in cash just to continue to get paid, and the 60-year-old, the retiree who owns his house outright or has a very small mortgage, who just is sitting on all his cash to be able to just make all this money off this cash, who again are then going and spending. There really doesn't seem to be any slowdown from the actual consumer. So if you're trying to keep interest rates higher for longer in order to get people to stop spending money and slow the economy down, it is not working, except for people who are younger, who are the people who actually really need the help the most. So anyway, kind of ramble over. I guess I'm just moderately frustrated today, off these kind of last couple of trading sessions, because I really feel like there was a potentially great setup for the catch-up trade that I've been looking for, and that catch-up trade just totally failed because of the Fed's language. It is interesting to see that Adobe's up a lot here after hours. Adobe at this point is up 15%. The numbers, I looked at them real briefly. I'm not going to read them out loud, but the numbers on Adobe pretty much look really good across the board. The interesting thing about this Adobe is that this is one of these software stocks, as are all the other software stocks, that have been really, really beaten up so far this calendar year. And Adobe's not as bad as some others. Adobe, I think, coming into this report is down, I'm eyeballing it, something like 30% into the report, which again, obviously, I don't know what the percentage is that the Qs are up at this point, but the Qs are supposed to represent tech, though I honestly don't think that they're doing a good job representing tech. I think they're doing a good job representing 7 companies that are almost so big that they're outside of tech. But Adobe, down 30% in the report. Probably most software stocks that you want to look at this calendar year are down somewhere between 30 and 60%, depending on the stock that you're looking at. So software is not in a bear market; it's in a depression, just about. So interesting to see that they got a decent report here where they're up 15%, because this is the trade that I'm looking for. But what really wakes up this trade more than anything, obviously, could be good earnings reports, But what wakes this trade up more than anything is the Fed saying, hey, we're going to give you guys some relief by beginning to cut interest rates so that companies like you can survive and thrive and innovate. And that it's not just Apple, Microsoft, Google, Amazon, Nvidia just taking over and dominating the entire globe, because that is really what it's actually turning into. That's kind of the macro. The market did pretty much exactly what I expected this morning based on the morning meeting. The SPYs, they were just fine, primarily range bound. They did, by the way, give once again our 0 DTE midday V bottom reversal in the SPYs. The Qs were even stronger than that, pretty much a consolidation all day, but notable, once again, midday absolute low in the QQQs. It's incredible how rare that used to be and how often it is now in comparison to how it used to be. And the IWM was just trash, kind of as expected. I really think off the Fed yesterday. So did the day after a Fed day lead to a trend day like it sometimes does? Not really, but it depends a little bit on what you're looking at. If you're looking at some of these smaller mid caps, then the answer to some degree is yes, and that trend was to the downside. If you look at the Qs, then the answer is no, but that's because Nvidia is up 4% again on the day, and Apple held in all day. So again, that's kind of where we're at. From an individual trading perspective, as far as some trades that I called out and some trades that I took, for the most part, it was pretty good. I did decide to liquidate my TQQQ position today. I made money in it. I kept it very small last night, and then I shorted it into the gap up further this morning. Originally thinking, because this is what the typical thought process would have been prior to the last 2 weeks, that the weak PPI would actually be good for the IWM and bad for the Qs, that we were able to pretty quickly dispel that this morning. Was able to make some money in the QQQ, TQQQ to the short side. It's still at that extreme extension zone of $7 plus. I probably should have kept some, but I said, I'm just going to reassess this trade tomorrow. I'm going to put some money in it, and I closed that one out. Great call in the low on the IWM today. I think a bunch of us were able to make some money in that. Literally called out the low. I mean, and I said it. I was like, guys, I'm buying a bunch of TNA. Honestly, I'm probably buying a little bit more than I should be, because I'm slightly on tilt from everything else I just discussed. But that actually turned out to be a pretty good trade. It's like one of my best names on the day, because, again, I probably bought a little bit more size than I should have, given the circumstance. My frustration day trade on the day was this BNED. I honestly just did not trade it well. It's always really important when you're analyzing your own work and analyzing your own trading. I just really did not trade this super well. I got myself stopped out of it several times. I was really looking to see if this thing could squeeze up, because the float's so low after the split, to $10 to $12. And but at the same time, I was trying to keep it tight because it's an $850 stock. So I got shaken out on the break of this inside 5 here, re-entered the position, but re-entered it small. I just really didn't trade this right. Because what I was doing, which is always a mistake, is I was sizing up after getting moves, and that's really not how I like to trade. In certain circumstances, that can really pay you to kind of average in further after you're getting some confirmation that the move is beginning to occur. It tends to be not how I like to trade. So I was like taking a small position, it'd beginning to work, I'd be adding to it, and then I'd be getting stopped out. Again, it's usually not how I trade. And then it's, I just got stopped out, so I need to make sure that my risk is appropriate on a second trade. So I take a little bit, make a little bit of money, and I go, okay, now that I made a little bit of money, I can risk a little bit more, and building in further. And then got stopped out on this low, and then I said, all right, I think I got stopped out 3 times, washed my hands of it, I said I'm done. And then after that last time that I got pushed out, which was like 780 or something, then the real move actually that I was looking for came in, moved to 10 to 12. I don't know. Sometimes these small caps can be tough, but when you catch them right, they can squeeze and really, really, really go. These post splits, when there's absolutely no liquidity. I mean, this thing traded the float. I can't even do the math on that. It traded the float like 30 times or something like that today. So I ended up losing money in the BNED, but pretty much everything else I day traded, I made money in. It's just more my frustrations stem, I think, a little bit more from my swings, where I was positioning myself for mean reversion on like weak CPI, and then like I was saying, the Fed just really kind of destroyed the trade. At least I did have some of those IWM puts to give myself a little bit of insurance on that, and I was able to make some money in the TQQQ, so that gave me a little bit of insurance as well. But still, some of these stocks are just getting absolutely decimated. I think that's all that I've got for you guys today, so I'm happy to turn it over to you all for any questions, comments, or anything that you guys want to review. So the first thing that I'm seeing is from... What's that GameStop doing? The GameStop's down now from the announcement. That's interesting. From Tate, have you created hotkeys for options? No, I haven't. If so, do you have any recommendations? I'm asking not from a technological perspective. That's because you're too smart to ask me for technological help. But from the viewpoint of someone who has been trading equities for a long time and is now switching to options, yeah, I mean, I'm in the same camp as you. I'm still, 95% plus equities, 5% or less options. They're still newer to me as well. They're not my biggest focus. I like them in certain scenarios, like again with that IWM short, or I like them to take shots once in a while a little bit, where my risk is premium paid and I'm comfortable with the amount that I can lose. But I'm not trading them so aggressively that I've looked into building hotkeys at all for options trading. I'm actually doing it point and click. From Tate, also, is volume a good factor to determine a higher low? It depends a little bit on the circumstance of the trade. Volume is definitely a confirming factor in more capitulatory type moves, more extension type moves. When you have that bigger extension down or that bigger extension up, and then you see volume increasing into that extension and maximizing into that extension, then I think that is a great additional layer of probability to tell you that you are closer to actually being at that kind of, for lack of a better term, top or bottom. So hope that helps, Tate. Appreciate the questions. From Aaron, would you rather short TQQQ or go long SQQQ? Great question. It's been one that I've been asked multiple times in the past. Happy to re-review it again. I prefer to be short TQQQ than to be long SQQQ. And the reason for that is decay. So levered ETFs have a natural decay that is entirely based on just how math works, that cause them to basically go down over time. And I would encourage you just to Google levered ETF decay, and you can read about it. There's plenty of articles online. But basically what you'll see is a 3x levered ETF is not going to move 3x of the underlying on a percentage basis, and it's literally just because of how percentage math works. And the more time that goes by, that's where the decay comes from. It's basically volatility decay, but the more time that goes by, the more pronounced the difference will be. So if, let's say, an economic number comes out, like the CPI did yesterday, and in 5 minutes the S&P goes up 1%, then a 3x levered S&P ETF is probably going to be up 3%, 3 to 1. If after a week's worth of trading with all types of fluctuations over the course of a week, at the end of the week the S&P is up 1%, a 3x levered S&P ETF will not be up 3%. It'll be up 3% less the decay. What that amount is depends a little bit based on how much movement there actually was during the week. But if I were to just take a random guess, it depends on the week, it depends on how much volatility there was, it depends on everything, a lot of factors, but maybe at the end of a full week, if the S&P was up 1%, the 3x levered ETF might only be up 2.25%. So you lost 0.75% due to the decay of how the math works on a 3x levered ETF. So if I want to be short the market via a 3x levered ETF, like I was yesterday through today, I would rather short TQQQ than be long SQQQ. That way, the decay is in my favor and not against me. It actually will help the trade over time. There is a balance to that, though. The balance to that is it hard to borrow? Maybe the 3x lever that ETF that you're looking at, and this is not the case with the TQQQ, has a cost to borrow because it's hard to borrow. If it's hard to borrow, then it could be that the cost of the borrow outweighs or is equal to the decay that comes from the ETF, in which case that there is no advantage. With TQQQ, it is hard to borrow, but there will still be an overnight loan cost. I don't know what that overnight loan cost is. Pat, if you're listening, maybe you can do a little exploration for us while I'm doing the meeting here and figure it out. And I know that it's a number that can change. It can constantly change from the clearing firm. But for some of these bigger stocks and bigger ETFs, the overnight loan rate is generally pretty steady. So I know at the end of the month, in my prop reports in my account, I will see that some money gets taken out as a result of me keeping the TQQQ overnight. What I've never done the math of, and this is, one thing that I've always noted whenever I'm asked this question, what I've never done the math of is what outweighs what. It is the cost of the borrow punitive to the decay, or is the cost of the borrow overnight so light that the decay is the biggest benefactor? I don't know. But without having done that analysis, I would generally say that I would prefer to be short a levered ETF than long the inverse levered ETF. So appreciate the question, Aaron, and I hope that helps. So we're live on YouTube, and I'm going to pop over to that YouTube where I'm live streaming this afternoon meeting to see what kind of questions and comments are coming from there, because I'm not seeing anything else in the VTF for the moment. Yeah, Cyril in just making a comment that I agree with in the YouTube. The fact that the IWM is basically retesting $200 is crazy, and I totally agree. The moves in TLT and the moves in the IWM, even though the IWM has been range bound, has been crazy. For the IWM to just be ping-ponging between 200 or even below 200 and basically 208, that's a huge range. I mean, on what day of the week is it? Thursday? On Tuesday, the IWM was at 198.40. Yesterday, it was at 207 and change. Today, it's retesting that huge weekly $200 level again. Just really crazy. Totally agree. Gabriel asking me if my title, I made the title of the YouTube for today's afternoon meeting stream, "The Fed Hates the Little Guy," asking me about the title. It's not meant to be towards traders and investors. It's meant to be just towards people, younger people, smaller people, if you will, and smaller companies, like I was discussing earlier. Is anyone long Adobe coming into earnings? I'm not. I was thinking about it after the fact, and I didn't think about it prior to the fact, which is all that matters. This might have been a good one to gamble some calls into, because it's down 30%, and I do think it's overall a pretty good company. From Gabriel, are you looking to be less aggressive after today's action? It feels like we just chop, not sell off, either in SPY, since the mega cap weeklies look good, just small caps keep getting gross. Yeah, so I do think, and I've been saying that while we have a mixed message from the market, it makes more sense to be less aggressive. And broadly, one of the big themes to successful trading is knowing when to be aggressive a trader, knowing when you need to go after it, because all the stars are lining up and you've got a strong advantage, and knowing when you should take a little bit of a step back because you've got a mixed message from the market, and the opposite of the stars aligning is what's actually occurring. And the conundrum and some of the frustration, I think, from these last couple of weeks has just been what I keep talking about: how great and bullish the S&P and the Nasdaq looks. Beautiful bull flag in the S&P, beautiful bull flag of the Nasdaq, which we talked about. Great continuation now for a couple of days, versus this RSP, which is not performing, and this IWM, which is not only not performing but looks outright dangerous. So we still have a very mixed message from this market, and until we can actually get clarity, you want to be a little bit less aggressive, I think, with your approach. From Kevin G, the market dynamics continue to be confounding, especially with this higher for longer news. I def thought today's macros would give us some continuation, but also given we'd had a couple trend days, we may cool off. What do you think should be our focus with the market dynamics moving forward? Sure. So focus with the market dynamics going forward. It needs to be interest rates. It needs to be the dollar. It needs to be the systematic flows. The systematic flows are really interesting right now. I haven't spent a lot of time talking about them. Pat's note. I'm trying to think if I still have Pat's note up. I might have closed it. Yeah, I closed it. But obviously, I can just re-click the button. Pat's note. I love the Goldman Sachs portion of Pat's note when it's in there. That kind of shows the flows. And there's been talk on this for a little while now. This Goldman Sachs tactical flow of funds. So we know that the CTAs for this week were sellers in any tape. That changes a little bit, I think, after this week, but it's still asymmetric to the downside, where I think they'll become small buyers in an up tape, small buyers in a flat tape, and bigger sellers in a down tape. But as we know, the S&P triggers on the down tape for the systematic selling are like a good bit lower, so it's far away and it's going to be tough to get there. But the interesting thing is all the data around July price action and all the data that's coming in around the election, which is all stuff that we have seen and that we know. So July is one of the most bullish periods of time in the market in a given year. Particularly the beginning of July, the first half of July. As you're coming into the second half of the year, there becomes a lot of new flow, buy flow, that comes into the market. And this is another thing broadly we've spent a lot of time learning. I've been learning, and we've been discussing for the past year. I was always a big poo-pooer of seasonality as kind of a general rule. Because my thought process was always like, okay, so sure, so the first 2 weeks of July tend to be the best 2 weeks of the year historically. But just because they've tended to be that way historically does not mean that they need to be that way for this July. That's always been my thought process. I still think it's a good, cautious thought process to have. But what I've really started to learn over the course of the last year is that a lot of what we see is seasonality. Like traditionally, this is a good period of time. Traditionally, this is a weak period of time. A lot of what we see from seasonality is actually related to forced flows that occur around that time of the year for a variety of reasons. And with the beginning of July period, it's that new second half of the year that actually creates a decent amount of forced buy flows that come into the market. Again, just read into Pat's note on a regular basis, and you'll be able to learn all about this. So from a market dynamic perspective, the systematic flows really are important. They can obviously be overpowered, especially by news moves like we've had this week, right? Technically, this is a sell week across the board, but it's obviously still been a very strong week for the S&P 500, just because the macro news has outweighed the systematic selling that would come in. And even though it's a sell tape across the board, I think the least amount of selling still comes into an up tape, and we have had an up tape. But I think that the flows actually systematically will become significantly more bullish starting in the beginning of July for most of that month. We could see a little bit of liquidity drain in the second half of June post-OPEX, which liquidity drain has the capacity to move the market in either direction. But we'll see some gamma probably get loosened off, and liquidity get a little bit lighter. Especially, one of the things that's been noted is that we have 2 midweek holidays in a row. We've got the Juneteenth holiday, which is a Wednesday, and then we've got the 4th of July holiday. I'm not sure which day of the week that is, but I know that it is also going to be midweek. So that tends to have an effect on liquidity to some degree as well. So we could see, I'd be a little bit cautious basically in the second half of June, just broadly with lower liquidity, especially because we have a mixed technical message from the market, but more constructive as we go into July because of those flows, but then less constructive again as we begin to exit July because we go into kind of this election cycle of the market. And what was discussed a bit in Pat's note today, and I've discussed it in the past just because it's something that I've seen so consistently just over the course of my trading career, and I talked about a little bit in the morning meeting today, is there tends to be selling into the election and buying after the election. It's literally happened every single presidential election, I think, over the course of my career. To some degree, we see it with congressional and Senate elections also, but not to the same degree as the presidential election, where what does the market abhor more than anything? The market abhors uncertainty. So the market abhors uncertainty, and you get a lot of uncertainty when you go into the election. After the election is over, you lose the uncertainty, and then there's no more uncertainty, and the market goes up. And that tends to be the situation regardless of Republican, Democrat, this guy, that guy. It doesn't seem to matter to the markets very much. What we do know is that the markets like gridlock more than anything, which is really sad because it just shows you how pathetic our political system is, that the market feels most confident to go up when it feels like politicians can't actually get anything done. But yeah, so as we go into the election, so potentially starting in August, we could see weakness from then through November, and then every single time, regardless of who wins, it seems like we get an immediate big pop as soon as the election is over. And it's been a trade that's worked great. I remember the last presidential election, we really positioned ourselves for it, and it worked fantastically well. I remember that November very well, and how we were able to catch the move in the market that came from it. So yeah, that's kind of where our market dynamics appear to be heading right now. Does Amazon care about interest rates? It shouldn't. I know Amazon's been a little bit weaker, but it's still pretty much sitting at all-time highs. From Uvixi Bull, I have begun selling a single 0DT at the money put in the micro ES every day, and my only risk management is to hold the position if I get assigned. When analyzing the return, it seems to beat out the market in both a flat and an up tape so far. Yeah, I know it does. Oh, it's a put. Okay, got it. Cool. Thanks for that feedback. In a down tape, it will lose money, obviously, but I have the capital to spare to hold this, and I wanted to put the market in a position where either one of two things happens. It either pays me or it gives me some more volatility and therefore the opportunity to take advantage of it. Obviously, only larger accounts can do this, but let's assume that if that's the case, what's wrong with this? No, I like the approach. That what I was about to say is that you might have a margin issue. It might be the only real problem with it. But yeah, it like anything else, it's about sizing and risk, right? So if your sizing and risk is appropriate and you've got the capital to be able to afford any margin issues, then yeah, sounds good to me. I don't know if anybody else has feedback on it, but that's mine. Kevin G expressing a little bit of frustration with the same things that we seem to be expressing frustration with, just trying to grasp the inflation, deflation, constipation aspect of the markets right now. From PB Freak, Tuning in late, I apologize if you've talked about this already, but do you have any thoughts on the petrodollar not getting renewed? I don't. A little bit outside my skill set. I'd have to do some more research. From Alcor, why trade the TQQQ instead of trading the NQ? Well, I don't trade the futures product. I could trade the QQQ. The QQQ is $478. The TQQQ is $73 with higher beta. I make money off volatility. I like having a cheaper priced ETF that I can take more size in, that yet gives me higher volatility because volatility makes me money. So that's my reason for that. As far as the NQ, which is a futures product, I don't trade futures. I am a prop trader with T3 Trading Group, and my feeling on futures is that the main reason to trade futures, if you're just an equity index focused trader, trading the S&P and the Qs, or even a few of the basic commodities, is that as a prop trader, so the number one reason why you would trade the futures product instead of the ETF is because of the natural leverage that you can get in a futures product that you can't get in the equity or ETF. But as a prop trader, I get all the equity, all the leverage that I could ever want. So for incoming prop traders into T3, we typically start by giving them 20x intraday and 8x overnight. More than enough to do a lot of damage to yourself or to make a lot of money with it. So for me, I would prefer to have equity access than futures access, because on some days I wake up and I look at the S&P and the NASDAQ and I say, hey, I don't think I have an advantage in the S&P and the NASDAQ. But if the S&P and the NASDAQ is all that I trade, then I'm going to be forcing trades. For me, if the S&P and the NASDAQ don't look conducive to trading, I don't trade them. And I've got a realm of thousands of listed stocks I can focus on, and many of them are probably going to be in play. They're going to be able to give me opportunities when the market itself is out of play. So if you're interested in learning more about prop trading with T3, you can reach out to me directly, Oldensmith at t3trading.com, or you can reach out to info@t3trading.com. From Apex Joy, do you think that Netflix looks like it's topping to you? This is the positive news this morning. Couldn't move the stock. I missed the news, so if anyone can fill me in on what the Netflix news was, I didn't see it this morning, or if I did, I forgot. But it held in. The technicals seemed like they held in pretty fine today. Maybe it wasn't as strong as the Qs, but nothing was as strong as the Qs except semiconductors, which outperformed. So to me, this looks like a bullish wedge that's building out in a stock that's been trading well. So I still think that Netflix looks good. But if there was important news and it couldn't go up on it, that sometimes is a signal to go on the other side. So pay attention to that. AJ is asking me my perspective on PayPal. I like the fundamentals a lot on PayPal. I think there's a value in this company, but the technicals have not been able to do it. The technicals have not been able to break out. They have not been able to clear this range that it's been in. Stock needs to get above 68. It needs to break higher. Here's another company that's down decently on the year. Started the year at, I don't know, 83 and it's trading at 61. You can find a lot of these companies out there. This is where I wanted to see if we get some rotation. We're not getting it because the Fed hates the little guy. But yeah, I like PayPal fundamentally. Technically, it needs to prove itself. It needs to set up. It needs to get out of this range. Gabriel letting us know that we're starting to get into the buyback window. That's an incremental thing. It's not like just one day you flip a switch and there's no buybacks anywhere in the market. It incrementally increases as you go closer and closer in earnings season. From Alan, I'm tuning in late. I am long the S&P from the 2 p.m. candle close. From the 2 p.m. candle close. Looking for a higher close at the end of the week with a stop loss at 50% of the 1 p.m. candle. You're saying 2 p.m. close makes me think that you're not in Eastern time. And I know you personally, Alan, but I apologize. I don't remember exactly where you live, and I think that you live somewhere in like Ohio or Pennsylvania or somewhere in the middle-ish there. So I'm not sure if you're referring to actually 2 p.m. Usually we go by Eastern time just because that's where the equity market is located. Even when I'm in Idaho, I go by Eastern time. Or if you're actually referring to the close itself. But sure, yeah, I mean, why not? S&P looks great for continuation. NASDAQ looks great for continuation. So why not? I see consolidation today, Eastern time. Okay, yeah, so you have a price cushion then a little bit, which is great. I see consolidation today forming a bull flag, Only Michigan inflation data tomorrow. Do you think we have another push higher to end the week? So I don't know. The spies and Qs are decently extended. So when it's decently extended, it becomes much more difficult, in my opinion, to predict and expect continuation. The spies are sitting in no man's land from a risk reward perspective, which makes me not like new trades, especially new swing trades. Day trades are one thing, scalps are one thing. But when I'm looking at an SPY that is between $5 and $10 above the 80 MA, broadly, I don't like the risk reward. I almost feel like it's a coin flip on continuation. And when the Qs are $10 plus extended, I think it's less than a coin flip. I think it's very difficult to get that continuation unless there's a news event that's creating momentum. So I don't know. I think that the spies and Qs are at a point here where they need to reset up. And that could be through sideways price action. It could be through building a bull flag, similar to what we just saw and what we just broke out of. But it could also just as easily be a price correction. So we'll see tomorrow. From Benjamin, can you explain what the benefits of routing your orders to certain exchanges are? I can. I do have to leave. I love that all the questions and comments are coming in today. I love when you guys do this. I am going to have to get going relatively soon. I have to meet up with someone in Midtown. But basically, I'll give you a very quick answer. I get into significantly more detail in a tape reading class I have in the training program, so any member of T3 gets access to that and they can review it. It's an hour-plus long class. But the way that you route influences how easily you get filled and what sort of rebate/costs that you will pay on the execution. So if you are providing liquidity, you can choose to route to an exchange like NASDAQ where the fill might be a little bit slower, but you're going to get paid a higher rebate for providing the order. If you have direct market access for your trading and you're not on some BS retail brokerage, then you get paid for your limit orders. If you are taking liquidity, it's the opposite. So when you're thinking about providing liquidity, it's a trade-off between getting paid a higher rebate and getting a better, faster fill. Most of the time, it depends a little bit on the stock, it depends a little bit on the time of the day, but most of the time, I personally prefer to go for the higher rebate. There are exceptions to that. I don't have time to get into the exceptions. And then when I'm taking liquidity, then it kind of becomes the opposite, actually. I try to take liquidity on exchanges where it's lower cost to take liquidity. That really matters if you do a lot of volume, and I do a lot of volume. So if you're just trading a little bit, it doesn't really matter as much, I don't think. Robert letting me know that Netflix got upgraded to 707. Okay. Yes, maybe it should have been a little bit stronger today. Plus, Netflix announced a live event, hot dog eating contest between two past champions. Does that include the guy that they kicked out of the Nathan's hot dog eating contest for taking a sponsorship from a plant-based company? Joey Chestnut? Ridiculous. The whole thing is ridiculous. Yeah. Thoughts on CRISPR short-term short to 63.50. Wow, CRISPR's trading really well. I don't know. It's extended, so you could look for it, but this is not what I expected this chart to look like when I typed it up. Because again, interest rate sensitive stocks just really struggled these last day and a half. This is an interest rate sensitive stock. So maybe I'm missing news here, but this thing just had a beautiful breakout through 60 area. Nice 3-day move here. It's kind of an inside day, rest day. There is extension there, but this is a momentum name. I'd be very cautious on that short. I think it might be too early. And if there's any realm or universe or possibility where the IWM thinks that maybe someday in a far distant galaxy we could get lower interest rates and the Fed could support the little guy, then CRISPR could roar. So I'd be careful on that one. Back over to the VTF. From Vikas, it seems that many thematic or popular names are filling the gap after earnings drops. Yeah. Recent examples, QRVO. Yeah, that's a nice fill. We know that Meta did it. We know that Netflix did it. I see you mentioned those names also. Where's that CRM? CRM did a percentage of it, failed down at the ADMA. It was a good short that we called out a few days ago on this thing. Great follow through off that pivot. See you guys. SWKS is another one. Wow, it's a big snapback on this. This almost looks like it had new news. What do you think of this trend? Is it more recent or has it persisted during a bull market? So you do see this more in bull markets. I'm not sure that these 4 examples are enough to constitute a trend. I want to see this happening more broadly. I can also point to plenty of examples, even like that CRM, which did bounce back to the ADMA, where it didn't happen. Where you didn't get a bounce back. The S is an example of another one that's doing a decent job filling back up. But there's plenty of others that haven't happened. Look at Path. Yeah, I know for sure that there's others that it hasn't happened with. So, I don't know. Keep an eye out for it. We definitely have some examples. It does happen more often in a bull market than it does in a weaker market, just because stocks are moving up. But I don't really have any other feedback for you beyond that. I just want to make sure that it's not just like a bias because of a few examples and more of an actual real trend. So I hope that helps a little bit. All right, ladies and gentlemen, 10 after 5. Unfortunately, I got to run, so potentially have to cut this one a little bit short. Appreciate all the questions and commentary. Like always, it's you guys that make the afternoon meetings great, more so than my rambling. That's the learning comes from you guys asking questions. That's why we do this. That's why we do this every day. We are here to support the success of the traders and the team. So that's all she wrote. Have a great night, everybody. See you tomorrow.